Hello, everyone. We'll just give a couple minutes for everyone to dial in before we start the webinar. So if we may ask you, just to stay a minute or two before we kick off. Thank you. Hello and good morning, everyone. Welcome to this webinar and thank you for joining us this morning. My name is Connie Wong. I am the Executive Director with Waystone based in Singapore. So today's topic is helping fund managers to prepare and navigate for the ODD and ESG of today. ODD is not something new to most of the managers today. When it comes to the interaction with investors, especially of course during the fundraising stage. So what we wanted to cover today is the key areas that investors are looking at and what has changed over the last 12 months, especially these days when we're all working remotely, utilizing different kind of virtual platforms. What are the common pitfalls our experts have been seeing when they're evaluating a fund and how managers can tackle them. And of course, the second part of the webinar, we're going to touch on the ESG, which is a very topical agenda and hot potatoes in the market where everybody was talking about that. And I was doing some research when I looking at this topic and something very interesting that popped up that I think that I've seen is as of the latest first quarter of this year, some $2 billion a day that flow into sustainable investment funds with a total amount of $2 trillion assets. So we thought it would be good for us to share, how the fund managers, they can integrate the ESG to their own investment portfolio without too much of compromising their own philosophy and thesis. And of course, what are the tools available in the market that managers can use to assess the ESG rating. And last but not the least, which is a Q&A session. So you all see a chat box on the right side of your screen, and you can send in the questions anytime to us throughout the presentation. And I would strongly suggesting you guys doing that because we have three amazing speakers joining us this morning. Igor, the senior consultant at Mercer, has been heavily involved, and also the discussion with investors almost on a day-to-day basis, and of course with the managers during the ODD process. And my fellow two ladies panelists, Rebecca, director with Waystone, and also Constantina, the head of risk analyst at State Street. So without further ado, and I think before we get into the content of the ODD and ESG, if I may ask each of the panelists to give us a brief introduction of your firm and at a very high level, how you have seen in the industry. I can maybe perhaps ask Rebecca first and then followed by Igor and after Constantina.
Great, thank you, Connie. And just, I don't know, there seems to be a bit of background noise on the recording, so I don't know if everyone else can just go on mute, sorry. Thank you, and so lovely to join you. I'm based in the Cayman Islands, hence why it's dark behind me, so but good morning to you all, and so lovely to be here. For those of you not familiar with Waystone, we are a risk, governance and compliance firm. So as a professional non-exec director, it's perhaps not surprising that I'm very much focused on the G in ESG. In terms of the conversations we've been having with our clients and the managers that we work with, I think a number of our managers are getting a lot more detailed questions around what they're doing around ESG. As Connie said, is a hot potato, to coin her phrase. We are finding that some of our managers are being caught a little bit on the back foot by the due diligence process and investors asking them about what they're doing around ESG. So what we really hope with this webinar today is to give you some tools to help you prepare with that. In terms of kind of how we've seen the industry adapt to ESG, I mean, this was very much traditionally a long-only area of focus. Now we're seeing a number of new entrants to the market with some really interesting products. I think the fund industry itself is so nimble and able to adapt to these different trends that we've seen with engine number one's a successful proxy battle with ExxonMobil, the real impact that we can have as an industry in this area. And I think ESG is quite unique in many senses because it's something that's been very much investor driven. And we are seeing some different geographical ways of addressing ESG. Obviously, the Europeans have led the way in terms of legislation, but the other jurisdictions aren't too far behind. So with that, I will stop and hand over to Igor.
Thank you, Rebecca. Yeah, just to give a quick introduction about myself. So my name is Igor. I'm the head of Mercer Sentinel in Asia, which is a dedicated team within Mercer. And we are kind of specialized conducting operational risk consulting, operational diligence, custody consulting, and as well transition management for our clients. And to give a broader picture about Mercer, Mercer is a global consulting firm, and we are usually in the areas quite strong in health, career, and wealth. And within the wealth businesses, it's where my team is sitting, the Mercer Sentinel team. And so, not besides operational due diligence and consulting, we also conduct we also provide other services to our clients, which is also part of the natural processes about investment due diligence, investment consulting for our institutional investor when it comes, for example, to strategic asset allocation, and obviously our third pillar, which is we also, I think, probably quite famous at the moment in the market, and one of the leading firms is our OCIO business, where we currently kind of holding almost $3 billion under asset under management. To give you a flavor of what our clients are, it's really institutional investors, endowments, foundations, pension funds, government agencies, or banks or insurers. Even family offices and partially managers are engaging us in certain engagements. And on the point which Rebecca highlighted, that ESG is kind of driven by investors, I think it's the same observations we are seeing it because the regulations across the globe are advancing at a different speed. And as well, I think it's a hot topic, as also colleagues say. It's always in the discussion every day in the news. Everybody receives newsletters or bombarded with new announcement of ESG managers. ESG strategies are implemented by managers, or what we recently see, a lot of impact funds have been launched, or bigger global managers establish center of excellence, particular focus on ESG. And so you can see in the market the demand for ESG experts is quite high. So it's not easy to fill all these gaps, but I think we are moving into the right direction for the moment. But we have to, I think, from my perspective, we have to keep in mind is there's no common formula for that. I think different asset managers offer different solution, and as well, it's really driven by regulations, and as mentioned before, regulators are advancing at a different speed. So it will be interesting to see over the next few years how we come together as a whole organization globally and adapt the ESG aspect in our investment process and as well in our due diligence process. That's from my side. Thank you very much. I will hand it over to Konstantina.
Oh, hello, everybody, and apologies for not having my camera on. I'm having a bad IT day today. So my name is Konstantina Founta, and I head the Risk Analytics Department in State Street, where the ESG solution lives. So just a quick introduction to ESG within State Street. This is not a new topic for us. State Street has been involved in research and monitoring and reporting solution around ESG for over 6 years. But what is actually new is the integration of ESG factors within the analytics space. As you know, it was a strategic move because we believe that ESG should not be seen in isolation, but seen, holistically within the investment analytics across the assets. A little bit about our clients. So here in APAC, we service asset owners, asset managers, and hedge funds, but we are part of a global team, so we see how globally the ESG trends evolve. And the ESG reporting and monitoring, as we see it here in APAC, is driven, as Rebecca said, from investors at the moment, not that much from regulators. Although we see this changing quickly, as we had many markets across APAC, issuing consultation papers and so on. And also, as we see across different aspects of investment analytics, not just ESG. There is a domino effect going across regions. So when there is a regulation in one jurisdiction, it will most likely affect different regions. So it's a global topic. Again, I will repeat, it's a hot topic. It means 100 different things to 100 different people, and I think the key for ESG is flexibility in the way of saying it, and flexibility in integrating it into the investment decision process, and also reporting and monitoring. Thank you.
Thank you, everyone. I think that's a very, very insightful, the level of the way that you are seeing in the market, and who are driving, who's driving that kind of a way of in the industry. And I guess the first question, maybe that's mostly to Igor, it's about, in the current time, I think we're moving away from the pandemic towards the endemic. What ODD looks like, and has there been any focus shift by investor? I think that's something like most of the managers here, they would like to know, and also to get your, your experience from that.
Sure. I think it's a good question. So maybe we have to go back a bit, where maybe last year February, when COVID was kind of picking up, unfortunately, across the region, and it definitely impacted the ODD process itself. Because when we look at the traditional ODD approach, which was always required to conduct an on-site visit, what does it mean? It means seeing the manager, visiting the office, traveling, inspecting the confidential documents on-site, which cannot be shared through email, inspecting the data centers. So with COVID and with the travel restrictions, obviously, it was not possible for us to conduct it. And to be honest, at that point of time, nobody really know what's going to happen. I mean, to the extent maybe some of us thought, we're going to lose our jobs, right? So because investors expect on-site visit. But from our investor perspective, of course, they had to make a decision, because looking that COVID was not disappearing as maybe a lot of people expected, and the market still was kind of volatile, and in particular China was doing pretty well. Managers had to make a decision. Investors had to make a decision. So what are we going to do? Are we going to delay our investment or funding with the manager? Are we going to restrict our funding only to managers which we know? That means we have already seen them before, we have conducted operational due diligence, or we know them through our relationships. Or eventually, the third approach was thinking about a different way. And we call it now these days a virtual due diligence. That means we set up, like today, a conference call with the different managers and then their stakeholders, and then go through their operational due diligence process and questionnaire. I remember in the beginning there was a lot of skepticism from investors saying, "Oh, you don't meet the managers. How do you know? How do you assess the knowledge? How do you assess the premises?" Yes, I agree. The skepticism was kind of justifiable, but I think it was important for consulting or ODD experts to kind of show we are not compromising on our quality, because we are adapting our approach. And the beauty about ODD is a good ODD is always dynamic, because ODD is always driven by market requirements, investor demand, and regulations. So it all comes together, and then usually we are able to justify our change in the ODD process, which led to the operational due diligence, which is conducted virtually. And what does it mean for managers is we had to ask specific questions about how do you manage the COVID situation, how is your BCP planning, how is your cybersecurity setup, your infrastructure setup. So generally, I think those was kind of areas of focus which we need to assess. And in my experience to share, I didn't see a big disruptions, because the asset management industry or the managers were kind of ready to adjust and able to activate the BCP plan, what was active for most of the managers. It also showed to the investors certain benefits, to be honest. Instead, in the past, when we conducted ODD, most firms, you visit the manager for one day, you have a 6 to 8 hours discussion, go through the different functions. Now we could spread it over 2 to 3 days, which gives a lot of flexibilities for both parties. The CFO, CEO has more time to dedicate, is able to share more. There's no time pressure per se. Documents we're able to share via a virtual data room. Of course, we had sometimes to sign NDA, but it means we still had access to confidential information, and the development of the IT infrastructure and the digitalization, which was kind of accelerating in the process, was quite helpful. So we could overcome the challenge and help investors to make make an opinion about the manager and the operational setup. So I think it was quite well managed across the industry. And even addressing the topics of concern investors had about cybersecurity, working from home, trade execution, because in the past, traders usually will work from the office and only execute trades from home. Offsite trading was not very common. But I think with adapting to the situation, a lot of managers have kind of revised the operating model, have adapted. To give you an example, of course, allowing trading from home, implementing Bloomberg Anywhere, thinking about cloud computing instead of having a primary data center on site. So there was a clear shift you can see. Even the discussion, do I still need a BCDR site somewhere? Actually, we can't even visit, right? Everybody has to work from home. So there were certain cost savings also to consider for manager. And as well, there were cost savings for clients because we don't need to travel. And a travel budget was always a big expense item for investors. So they could save on that. So I think the outcome was well managed across the industry. And I think the investors are kind of used to the approach we are currently driving in the industry. But we have to observe, I think, over the next few months, maybe 6-7 months, are we going back to on-site visits and are we going back to the traditional model? In my view, I think it will be a risk-based approach. Say that if we know the manager, if we have seen them before, probably we don't need to come back to do a full ODD with a full on-site visit. But probably for new managers which has been, for example, only incorporated, or the PM or the CEO is not that well known in the industry, then obviously the on-site visit will probably be triggered by investors, and that will be a requirement. So that's in a nutshell, if I can summarize.
Thank you, Igor. I think that's really interesting to hear from you. Also, the change of form of the ODD process and what's the kind of slightly different angle or additional part of the additional part of the component that investors are looking into that. And you mentioned about the cybersecurity. You mentioned about the way that the managers are operating their business. And I have one just out of curiosity. Are you seeing any increased investor focus on the ESG and also like perhaps the board diversity, and how has the due diligence process evolved, if any, to incorporate these factors?
Yeah, that's a good question. I think it comes initially to the point I was explaining. The ODD process is quite dynamic and always driven. As ESG is driven by investors, our ODD process is also driven. So investors requesting for the scrutiny to understand how the manager incorporated ODD at the investment process to make an informative decision, to make sure they're in line with the investment guidelines and what kind of ESG data are used to establish this investment guidelines and as well ESG ratings. But as well, managers want to understand, as you correctly highlight, what happened at the firm level. What does the manager do on diversity inclusion? How they really incorporate these values in their corporate culture? And this is an important factor because it will always align as well with the interest of the investor and the manager. There should be a natural alignment, and if there's a disagreement, it could be a difficult challenge to overcome over time. And from our, I can add in on the ODD perspective. Obviously, what happened is ODD expert will focus on this area and want to understand how the manager overcomes and incorporate that. But it's not only having a policy in place and having be a signatory to any guidelines or principles. It's really demonstrating it, how you lived it, and quantify, and able to prove it. It's in a quantitative approach as well.
Okay, thank you, Igor. That's really good. That you shared a part of what you've been seeing, along the process, how it evolved. And while we're on the topic of the board diversity, and Rebecca, I know you sit on board as the independent director. You possibly have been talking to the investors, also especially with the managers as well. And was there anything you wanted to share, perhaps here, like how you seeing the interactions amongst various parties as the independent director?
Yeah, absolutely. And I think Igor's point about culture at the firm level is incredibly important. I think investors increasingly want to understand what's going on under the hood, and they want to invest with the good guys. What we've really seen, I think, is around the ESG due diligence, that the questionnaires have really evolved. A couple of years ago, it's very much, do you have an ESG policy, or are you a UNPRI signatory? And now it's much more involved. It's a much deeper dive to understand how you're integrating ESG into your investment process. Igor touched on data service providers. So they want to understand which data service providers are you using and how you selected them. There are other examples where I've seen where they're asking things about, what the carbon footprint is of the portfolio and how you're measuring that, and what is your ESG objective, what is your risk framework, what is your engagement policy with your portfolio companies, how have you used your proxy votes, give us some examples as to how you've incorporated your ESG factors successfully in your portfolio in the last 12 months. So it's a lot more involved, and as I mentioned before, I think it's a non-exec director. It's my job to sort of ask the questions to the managers before they get them, because I think it can be quite daunting sometimes as a manager when you get if you're not necessarily an ESG fund or you haven't got an ESG policy, and suddenly you get a 5 to 9 page questionnaire around ESG due diligence. It can be quite challenging. So it's just thinking about those things up front. And if you don't have an ESG policy, that's fine, but clearly be prepared to clearly articulate why you don't have that. And again, to Igor's point, focus on what you're doing at the manager level, because maybe you don't have a product that lends itself well to an ESG strategy. Say for example, you're a commodities manager, but what can you do? What are you doing at the firm level? I think that can be tremendously powerful for managers to have that story sort of tightened up and ready to go.
Thank you, Rebecca. I know you touched on the questionnaires, and that's maybe also back to Igor. And I think there's a question that on the ODD process in general. It appears to some of the managers it's getting more onerous. And I would say if you have anything to share, maybe the top 3 to 5 things that you think managers can do to prepare for the ODD, and also any common pitfalls to avoid, given that I know you've been talking to allocators, investors on a day-to-day basis. So you're possibly the best person to share with us here. I think you're on mute.
My apologies. Yeah, thank you, Connie. Definitely, I can share more around this topic. And looking at the ODD process and giving you a flavor, yes, it becomes a bit more onerous. And the reason is, of course, because we want to deliver a good product to our clients and really understand the manager's business. And this requires looking at the manager from almost like a 360-degree angle, looking at all the processes, understanding their policies and controls in place. Who are the service providers they're using in general? Who is the fund administrator? What are the lawyers? What are the auditors? And it requires time to get this kind of insight. So I understand managers have to go through this ODD process sometimes with various companies and various investors, but I think there are a few things they can really do. And because if they would compare the different processes in general, the way ODD is run is a global standard and have a similar concept in key themes like valuation, trading, BCP planning, cybersecurity, as mentioned before. It's probably now a hot topic more than ever before. But most importantly is, if I can advise managers on that aspect, it's important to do your homework, be prepared. Focus on the areas what they were going to ask, right? It's sometimes quite obvious of what is to say valuation, trading, how do you manage your cash control, the cash movement out of the fund, how do you interact with the fund administrator, how do you onboard investors. So these are kind of topics you can really already cover before you go into the ODD and be familiarize yourself. Another aspect is also being transparent. I think that's my recommendation. Don't hold back with information, and try to provide us the documents and support the ODD expert in their work. I mean, it should be a dialogue between you and the ODD expert from the beginning, and not only during when we meet at the discussion, because when we meet, we should already have a dialogue and establish the base we like to explore and to what extent we want to go in certain topics. And that's why I think I would recommend to managers at the beginning stage, you should call the ODD expert maybe as much as you need to understand how the process is going to work, what are the questions you might, in areas you're going to focus, what documents you like to see. And if this is not clear, it's very difficult to create a very effective ODD process, and considering the time constraints you sometimes have, particularly when we go back to on-site visits. And the fourth point I will highlight is, when you tell your story about your company and about your process, be consistent. Because if your policies say A, but you do B, and then your staff represents C, it's kind of difficult to accept that and to understand how does the company and the processes are really led and controlled, and what kind of oversight is provided if the senior people don't really understand how the process is really properly executed. And I also have to be honest with the managers, I think here, and they need to understand, yes, ODD will never win your mandate, to be honest. It's really driven in the first aspect of looking at your performance, analyzing it from an IDD perspective. But I have to highlight that ODD can lead that you lose a mandate, because if you don't pass your ODD, you can be the best manager in the world with the highest performance and turnover. It will not give you that. The client will concern and probably not give you the mandate. So it's important to be ready, and as highlighted with some of the advice I mentioned, to consider in that aspect. And your second question about what are the common pitfalls? It's very difficult to say sometimes, because every manager, in my experience, is quite individual. The way they run their processes, the way they set up. There's some common processes and controls in place. You can find particular manager set up in Hong Kong. You can see there's a similar pattern, but still there are differences. And that's why the risk we sometimes identify can be very different. But if I would summarize it in what we commonly see across the manager is, of course, these days, again, I have to emphasize, cybersecurity is a hot topic. It becomes even more now when everybody is working from home. You really want to understand how do you adapt your cybersecurity policy, your data security policy to your business. Do you have hard disk encryption? Do you restrict access to public sites? Do you do cybersecurity training, phishing exercise, penetration testing? So all these topics, even for smaller managers, you need to really think about it. And of course, it's always driven also by the asset classes, the way private managers run compared to hedge fund managers could be different, but still, there must be a consideration that we should clearly demonstrate that you have considered all aspects. Another point is about segregation of duties, particularly for smaller manager, when you have the chief operating officer is at the same time the compliance officer. Yes, there could be a conflict of interest, but even for smaller managers, there is an acceptable threshold, I would say. But most importantly, you really need to demonstrate that you separate the investment team and the operations team. So there should be no overlap in duties and responsibilities. And this can be easily achieved with the right hires, people with experience, and a clear reporting line which is defined. Another point which we see most of them as a weakness is about the conflict of interest. When we talk about personal account dealing policies, gift and entertainment, use of expert network, there are still generally a lot of weaknesses around that, and managers are surprised when we pick that up, because they say, okay, the regulations require us follow. Of course, as a consultant, we always follow the best practice which we see in Mercer and what we have established over the years. So I think that's always a hot topic, conflict of interest, and it will be a hot topic even from a regulatory perspective. Another point I think I will highlight is about succession planning. Again, it's probably more applicable for smaller firms and to mid-tier firms, where it's an owner-run firm where the CEO is at the same time the owner and holds 100% equity stake. A lot of firms probably don't think about what's going to happen to the equity stake once the CEO becomes incapacitated. Without standing, of course, we understand in all the PPMs you will have a keyman clause which gives the investor the opportunity to redeem out the fund if something happened to the keyman. But I think managers have to think about beyond that and understand what will really happen to the owner of the firm and the equity stake once he becomes incapacitated. Because it doesn't mean you have to close down the firm. Is the ownership equity or the equity stake stuck in their estate and you cannot make any decision? So there are discussions which the manager should have to understand how to approach that. As well, cash control, it will and remain, I think it will always be a hot topic across managers. You have to have a proper cash control in place, particularly for funds which are administrated internally. There's no way that this is a topic which will be not scrutinized to the extent that you need to really to prove how you access the bank account. Is there multi-factor authentication? So, and at least a dual signature approval, etc. So all these topics need to be covered. And last but not least, which we always see a kind of a weakness, in particular in an Asian context, is about when we think about the fund governance. And when we set up a fund, particularly on a hedge fund, and it's a company set up, from our perspective, we always would expect the independent directors to take on the board. That's quite important for us to represent the interest of the investors. And as well, when we look at the private equity setups, definitely, if it's a limited partnership, you have to establish an LPAC. I think it's common practice, definitely. Less practice we will see in the context of hedge funds, sometimes having majority of independent directors. That's the best what you can achieve, and that's what investors actually also love. And the last topic I would say is about best execution. I mean, that should not be taken lightly. You need to really demonstrate how you achieve best execution, and do you have an oversight over an independent control functions who really checks that the trader has achieved the goals and follows the order placement policy you have established. So that's in a nutshell, I would say, kind of some of the topics we will consider as important.
Thank you, Igor. I think that's a really full of thoughts for everyone here. I mean, the point that you touch on, the alignment of interest, the segregation of duties to avoid the conflict of interest, having the board independent. I think these are for sure the key factors that managers can take away today when they go through their internal process and what they can do it as a best practice, especially if they're looking to attract or to attract the capital from institutional investors, more sophisticated one where you're trying to, create a longevity, a relationship with your investors. So consistency and also transparency. That's also my two takeaways here. And thank you, Igor, on that part of the ODD. And I guess we can flip a little bit on the ESG. It's a very broad topic, and there's a number of things that we can touch on, and we can talk for days about the ESG. And so I guess if maybe I can over to Constantina, just to your point of view, how we can define or maybe narrow the ESG objectives and how we can set the performance benchmarks. I know that there's no really such a globally accepted, a consistent definition of sustainable ESG investing, and it can mean different things to investors, and the way that managers can adopt it, it's also differently. So, Constantina, if I can invite you to share with us, that would be lovely.
Yeah, sure. Thank you. As I mentioned before, ESG means different things to different people, and this is also translated on how managers integrate ESG into the governance, into their strategy, into their risk management and investment process, and then at the end, the analytics and the monitoring and reporting to their investors. So I think it's commonly accepted that there is no one size fits all, for sure, either on the objectives or on how to integrate the ESG. So, and different market participants are in different stages of the ESG journey. So, yes, it is hot topic at the moment, but ESG is not new. So there have been asset managers that they have integrated ESG aspects into the investment decision-making process many years ago, and they communicate this. And when we say ESG, there is a tendency and to think only the E of it, like the environmental, like carbon emissions. And I know that especially here in APAC, regulators have been focusing more on the E, like Singapore, Hong Kong, Australia. So in all the communication with the market participants, we see a strong, direction towards the E. But there is also the S and the G that they're equally important, and this should be part of the ESG journey as well. So how we implement the objectives. So there can be small steps before big jumps. It can be positive or negative screening, or it can be, a strategic approach of, how we incorporate this into the core of the investment management process. As you say, there are not universally accepted standards, but there are many frameworks out there, and there are many popular frameworks that they're a good first step on standardization of ESG. But yes, there are the frameworks there, but none of the frameworks actually tell you how to implement the E, the S, and the G, or how to report. So they give you the, the general direction. So there is a lot of room for interpretation, which is a good thing, but also, it's a challenge itself. And this is how we try to help our clients. I think that relative monitoring and relative objectives are gaining ground. And this is also has to do with the reporting at the end of the day, like how my investors, that they ask for more transparency, for more disclosures, what is their level of understanding of ESG? How if I give them a number, how can they digest the number? Do they know what number means? So what I've seen over the past 2 years that I'm like largely involved in the ESG reporting and analytics, that I see a trend towards relative, which is easier to maintain, easier to understand from the investor's point of view. But also the objectives become also more complex, and this is it comes from investor demand as well, but also from regulatory guidelines, like for example the controversies, the reputational risks, stress testing on carbon aspects, physical risks, carbon earnings at risk, and all this. So it becomes a complicated topic that the market participants will have to be prepared to integrate in their processes. Yeah, that's the topics I would like to highlight on the objectives. Now on the performance side, and performance I think is it's yet to be proven for the ESG label. And especially focusing on the past 12 months and connecting it to the COVID challenges. The past 12 months have not been standard normal conditions, and with the ESG as a hot topic as well, I think it's too early to draw conclusions about the performance of ESG funds versus non-ESG funds and so on. We need a longer history of data under normal market conditions, standard market conditions, without extreme volatility, to be able to draw conclusions around performance.
Thank you, Constantina. And I think it was a very interesting part that you mentioned about the performance benchmarkings. And I think Rebecca and myself, we had a number of calls over the last few months. Managers are asking what kind of benchmark they can use, to kind of to rate a certain portfolio companies, or maybe the fund itself when they're doing the internal assessment. And maybe Rebecca, you can share with us, what you've been seeing in the market, and also I recall that there is also a manager asking, like, is ESG and policy is a nice thing to have? And I guess Rebecca, you can really share with us on that 2 points.
Yeah, I think it used to be a nice to have, and I think it used to be one of those sort of tick the box and kind of move on, and it has evolved. And as I mentioned beforehand, if you don't have an ESG policy, just be prepared to clearly articulate why that is. I think Constantina made some fantastic points there around the flexibility and what ESG means to different people and different investors. So you'll have some investors that maybe they've aligned themselves with certain of the UN Sustainable Development Goals, and so maybe they're looking for a certain type of reporting or a certain type of policy to meet those. Going back to Igor's earlier point about alignment, that's still critical here. So when you're developing your policy, thinking about what your investors actually want, and there's this growing belief within the industry around the materiality of sustainability risks and how they can impact investment returns, particularly in the longer term as we struggle, as the society struggle to deal with things like climate change, lack of water, and there's some fantastic tools out there. I mean, one of the points that you raised earlier, Connie, was about sort of lack of definitions in the market and sort of no consistency. And the SASB has done a fantastic job there. I think their materiality matrix is a really, really useful tool for managers to look at when they're thinking about how they can develop their ESG policy. And there is some regulation obviously coming. The EU taxonomy will help standardise some of those terms But yes, the policy is it is no longer a nice to have, in short.
Thank you, Rebecca. And I think we're also conscious of the time. And I think the one side point you touched just now, and it's kind of aligned with one of the questions that we have here, is about the ESG tools available to the managers. And I guess today, because we have quite a bit of managers who are on the line who are actually Asia-based, and some of the time they might struggle to identify the suitable tools they can use. And maybe Rebecca and Constantina, you can share what you've been seeing in the market that you think could be potentially a tool that managers here can consider?
Yeah, the tools. Yeah, I mean, tools. Number one, which is also the biggest challenge of integrating ESG, is ESG data. The vendors you're going to use, there are so many vendors out there with using different methodologies, different approaches, focusing on different aspects of ESG. So it's about finding the balance between what your objectives are, what you are trying to achieve, or what how would you like to meet your investors' reporting needs, their disclosure needs as well, and the right vendor. And combining the vendor again with the framework, as Rebecca said, there are different frameworks there that meet different needs, like the SASB framework, TCFD, the UNPRI, that are like some of the most popular ones. But again, ESG data, finding a right framework and finding the balance between reporting, the reporting needs of the investors, the regulations are coming for sure, and we have to, keep a forward-looking eye and not just looking at today, and having always in the back of our minds that ESG is ever evolving. Like even for those that they consider to be ahead of the game, sophisticated ESG players, there's no static notion when it comes to ESG. It's so dynamic, and we need to be prepared for the next step, even if it's driven by our investors, or even if it's driven by regulation, or if it's driven by ESG itself as an asset class as well.
Yeah, I think the regulation is really important. So the SEC came out with a risk alert in March, and they've also intending to create an ESG and climate task force. So this is coming, and as part of that announcement, I mean, the SEC in March, they said climate risk and sustainability are critical issues for the investing public and our capital markets, which gives you some idea as to where they are going with this. And one of the key things around that is the risk alert in particular was around funds having an ESG policy and not necessarily adhering to that. And that's where the governance piece for me is really, really important in terms of that oversight. Do you have the right people sitting on your ESG or sustainable and responsible investing committee? Do they have the right expertise? I mean, a number of managers are struggling in-house to have people on their teams with ESG expertise. So you need to bring someone in externally to help you with that process, and maybe sit on your committee and help you get off the ground in terms of developing your policy and then overseeing that so that you stay on the right side of these regulations.
That's a really good point. I think, Rebecca, that's on the ESG governance, right? That's not something that we often hear about people talking about that. But when you go through, the ODD process, or maybe the due diligence checklist, you often get asked whether if you have a ESG committee member set up, and what's their kind of background, whether if there's any diversity and inclusion on that one. And I guess possibly just the last question that we're going to pick from the attendees today. I know there's a couple of ones coming up also, but the last one, I guess, is to all the panelists today. We touched on the ODD, we touched on the ESG, and maybe just to pick your brain, given that your expertise individually, what is your view? Should managers engage with investors on the ESG? That do you think is the best fit? I know that there's a lot of conversation about that, and it could be potentially kind of drive to a greenwashing. And what should the managers be I mean, be careful, or like what would you say for them as a takeaway? And if I may ask, maybe just Igor to start with, followed by Rebecca and then Constantina.
Yeah, sure. I think it comes back to transparency in aligning the common understanding what ESG is. I think looking for the dialogue with the investors is important, and I think as Constantina highlighted, the understanding what ESG stands for and what it should be is very different across investors, across managers. It's important to find a common understanding, I think, in that aspect, and be also transparent. I mean, also have to explain to the investor, listen, for this asset class, it's difficult to achieve ESG scoring or follow the ESG methodology or implement in our investment process, because it's not a purely equity strategy. It's a multi-asset strategy with derivative instruments. So there are a lot of challenges, I think, which needs to be discussed with the investor. But I think it's about also demonstrating the investors, okay, we have it on our radar. We are having active discussions internally. We think about hiring people. We are lining out, or we're developing a roadmap where we want to be in the next 5 years. So I think that's important factors. And again, it's just to emphasize having the dialogue with the investors is most important.
Yeah, I agree. I think in terms of the alignment and making sure that you're giving your investors what they need, and just being, in terms of your ESG reporting or any statements you're putting out publicly on your websites about what you're doing, just make sure that you're actually doing that. As you saw, the SEC is really, really focused on this, and I think we're going to see a lot more regulation in this space. So, the golden rule of compliance: just do follow your policies and do what you say you're going to do.
Yeah, my comment would be that the ESG is definitely here to stay. As Rebecca said, it used to be a nice to have, but not anymore. But then, the integration of ESG is not a race. It should be, a step-by-step process. And again, the self-reporting part of it, especially in regions that regulation is not as solid as in Europe, it can be tricky. How do you attract investors? Or what are the requirements of your potential investors, and how do you meet those? So make sure that there is a balance between what you're doing internally, what you plan to do internally, and how this presents, outside your organization. And make sure that there is consistency and that there is a plan.
Thank you, all of the panelists today. I think there's a few really good points and the key takeaways on that, and the consistency, alignment of interest, and be open and engage with an active dialogue with the investors, and do what you say. I think these are really good points for managers today. Be cautious and also be consistent while you're kind of doing your pitch. And I do appreciate, Rebecca, Igor, and also Constantina joining us today. I think you guys are amazing, sharing with us, your knowledge, subject matters in covering the ODD and ESG. And also, again, to everyone who, took the time this morning joining with us, listening to us on this particular topic. And for some of the questions we didn't get a chance to address today, again, we will reach out to you individually, and we're happy to also share, the context of each of our subject matter experts today. And thank you for everyone for joining and participating. And I wish you guys a very good day. Thank you. Take care.